Welcome to the Deep Dive, the only place where information overload meets instant clarity. Today, we've got a really interesting stack of source material, requested by you, our listener. We're doing a detailed stock news report.
That's right. We're focusing on the top 3 U.S.-based internet content and information stocks.
Yep, the big ones. Alphabet or GOGL, Meta Platforms, Meta, and also Pinterest, PNS.
Exactly. So our mission here is to give you a solid journalistic rundown. We'll unpack the fundamentals, look at the technical signals, recent news, valuation metrics, all that good stuff.
Basically getting you up to speed on these major online players.
And it's a complex area. You've got AI just dominating everything, regulatory pressure.
And the scale difference here is wild, isn't it? We're comparing like a $3 trillion company with a $22 billion one.
Absolutely. How do you even compare GoGL and Meta, these giants building this massive AI moat, with a much smaller, maybe more nimble player like Pinterest? It's a challenge.
That's the core tension we'll be exploring, that scale versus agility.
So just to be clear, our approach is purely journalistic based on the data provided in the sources. And this is really important. This is for informational purposes only.
Right. Definitely not investment advice.
Not at all. Anytime we talk profits or losses, it's just hypothetical paper money scenarios using past numbers from the sources, just for context.
Got it. Okay, let's dive in. First up, the absolute giant, Alphabet Inc., ticker GOGL.
Right, GOGL. I mean, the scale is just immense. Market cap, $3.04 trillion. Last close we saw was $251.46, and their earnings are coming up October 29th.
And structure-wise, it's basically Google services, search, YouTube, the moneymakers, then Google Cloud. That's their big enterprise growth engine.
And the other bets. Can't forget those. Waymo, healthcare tech, that kind of thing, high potential stuff.
Looking at the financials, it just screams stability, doesn't it?
Yeah.
Profit margin over 31%. That's huge.
It really is. They turn revenue into profit incredibly well. And the balance sheet is, well, rock solid. Debt to equity is tiny, 0.11.
Yeah, and that quick ratio, 1.9. Can you unpack that a bit? What does that really mean for them?
Sure. So the quick ratio, it's basically a measure of liquidity. It tells you if a company can cover its immediate debts without having to sell off its inventory. So a ratio of 1.90 means GGL has almost double the easily accessible assets it needs to cover all its short-term liabilities. It's incredibly liquid, very secure financially. A fortress, like you said.
So super solid foundation. How's the market valuing this? What are the ratios telling us?
Well, the PE ratio is 26.78. The forward PE, looking ahead, is a bit lower at 23.42. For tech growth, we often look at the PEG ratio.
Price earnings to growth, right?
Exactly. And for DOGL, it's 1.77. Generally, a PEG over 1 suggests the market's pricing in that future growth quite highly, and the expectation is solid. About 15% EPS growth projected over the next 5 years.
Okay, so the market sees the growth potential. Now, the technicals, the chart action, how's that looking?
Pretty fantastic, actually. Performance over the last 6 months, up 64%.
64%. Wow.
Yeah. Year to date, it's up nearly 33%. It's showing real strength, trading just, 1.77% off its 52-week high. Momentum is strong.
And the indicators, SMAs, RSI.
All bullish. The price is comfortably above the 20-day, 50-day, and the crucial 200-day simple moving averages. In fact, it's over 33% above that 200-day SMA.
That's a big buffer.
It is. It suggests this isn't just a blip, it's a strong, established uptrend. And the RSI, the Relative Strength Index, is at 63.14, which confirms that strong momentum. It's not quite overbought yet, but definitely strong.
Analysts seem to be on board, too. Target price around $253.91. But some recent calls are way higher, like Mizuho at $295.
Yeah, the sentiment is very positive, and the news really centers around one thing.
AI has to be.
Absolutely. AI infrastructure dominance. They're just pouring money into it. We saw that $15 billion commitment for an AI campus in India, another $9 billion for South Carolina. They are positioning themselves in the AI winner's circle, as some analysts are putting it.
That's serious capital deployment. But we should probably mention the potential headwinds, too, right? The source material mentions possible UK regulations on search dominance.
True. Regulatory risk is always there for these giants.
And also the insider selling. CEO Sundar Pichai selling shares regularly. Is that something to worry about or just standard executive stuff?
It's something the market always notes. Often these are planned sales, for diversification or taxes. But the consistency and volume mean people watch it. For now, though, the positive AI story seems to be outweighing those concerns.
Okay, let's do our fun with math bit. Hypothetically, $10,000 invested 6 months ago.
Right. Based on that 64% gain, That entry price would have been around $153.33. So $10 gets you about 65 shares, give or take.
And that 64% gain means?
That $10,000 would hypothetically be worth about $16,400 now. So a paper profit of roughly $6,400, a very strong run.
Yeah, definitely leading the pack in that period. Okay, let's shift gears to the next giant. Meta Platforms, Meta.
Okay, Meta. Still a behemoth, market cap $1.79 trillion. Last close was $712.07. Same earnings date as GOGL, October 29th.
And Meta's structure is kind of twofold, isn't it? You've got the incredibly profitable family of apps, Facebook, Instagram, WhatsApp.
The cash machine.
Exactly. And then there's Reality Labs, the AR/VR division. That's the big, expensive future bet.
It really is. And what's wild is how profitable that core app business is. Gross margin, almost 82%. Profit margin, nearly 40%.
Wow, even with all the spending on the metaverse stuff.
Yep. It shows just how efficient that core advertising engine remains. And the return on equity, ROE, reflects that too, over 40%. Very strong profitability.
Valuation-wise, how does it stack up against GOGL?
Pretty similar, actually. PE is around 25.79. PEG ratio is 1.98. So again, the market is pricing in growth expectations, which are around 13% for EPS over the next 5 years. And sales growth quarter over quarter was strong, over 21%.
They definitely have the financial muscle.
Okay.
But the technical picture looks a bit different from GOGL's right now.
It does. There seems to be some short-term weakness or maybe consolidation happening. While it's still up big over 6 months, almost 42%, the current price has dipped below its 20-day and 50-day moving averages.
Okay. So short-term momentum is fading a bit.
Seems that way. The RSI confirms it, sitting at 42.02. That's moving towards neutral, maybe even a little weak. It's still above the long-term 200-day average, but only by about 6%, not the huge buffer GOGL has.
So strong financials, but the chart's showing a pause.
Yeah.
How are analysts viewing this? They seem bullish according to the source data.
They are very bullish. Recommendation score is strong at 1.32. Average target price is up near $870. And you've got some targets like Pivotal Research way up at $930.
So why the bullishness despite the recent chart weakness?
Again, it's the AI arms race. They're investing heavily, just like Google. That $1.5 billion data center in Texas, strategic partnerships with Arm Holdings, CoreWeave. They're building their own AI moat.
And the sources mentioned they're feeling pressure from competitors like OpenAI, having to move faster.
Yeah, that seems to be a factor. The competitive landscape is intense. And similar to GOGL, we see reports of consistent insider selling, including from Mark Zuckerberg himself. Again, likely planned, but noted by the market.
Right. Okay. Paper money time for Meta? $10,000 6 months ago.
Okay. So entry price would have been roughly $502.31.
Yeah.
That gets you about 19.9 shares for your $10.
And the gain was 41.76% over that half year.
Meaning that $10,000 investment would hypothetically be worth around 14,176 cents. So a paper profit of about $4,176. Still a great return, but yeah, reflects that slight coring off compared to GOGL's recent tear.
Understood. Okay, we've covered the two giants.
Yeah.
Now for something completely different. Pinterest, PANS.
Right, Pinterest. This is where the story shifts dramatically from sheer scale to potentially growth and efficiency.
Yeah, the size difference is stark. Market cap just $22 billion. You said GOGL is what, 137 times bigger?
Something like that, yeah. It's a totally different league in terms of size. Last close was $32.59. But the financials, they tell an interesting story.
Especially the efficiency metrics, right? Balance sheet looks super clean. Current ratio is huge, 8.76. Almost no debt.
Exactly. Very lean, very liquid. And that return on equity, the ROE, is massive. 48.08%. That's the highest of the three we're looking at today.
Higher than GOOGL and Meta.
Significantly higher. It suggests management is incredibly effective at using shareholder money to generate profit. But the real standout metric, the potential aha moment here, is the PEG ratio.
Okay, what is it for PIN?
It's 0.48, just tiny, compared to GOOGL's 1.77 and Meta's 1.98.
Whoa. So a PEG under 1 usually means?
It suggests the stock might be undervalued relative to its expected growth. The market seems to be getting that future growth potential very cheaply compared to its earnings multiple, at least based on this metric.
And the growth expectations are high.
They're the highest of the three, according to the data. Projected EPS growth over the next 5 years is nearly 25%. And their recent EPS growth quarter over quarter was astronomical, over 346%. They're growing fast and converting it to profit efficiently.
Okay, that sounds amazing for growth investors. But the technicals, they paint a very different picture, don't they?
They really do. This is the major friction point for PNentis right now. Yes, it's up 28% over 6 months, which is decent, But recently, it's been hit hard. Down over 12% in the last quarter, down over 10% in the last month.
Ouch. And the moving averages?
It's trading below all the key ones, the 20-day, the 50-day, and the 200-day SMA. That's technically a clear downtrend signal. The price is more than 20% off its 52-week high.
So, strong fundamentals, high growth potential, very low peg. But the chart looks weak. How do analysts justify targets as high as $51, like UBS has?
They're likely focusing on the longer-term strategy. The news highlights Pinterest's push into AI-powered shopping and its strong traction with Gen Z users. The idea is they can carve out a unique niche in e-commerce discovery.
So betting on a turnaround based on strategy.
Essentially, yes. The current weakness seems tied to their Q2 earnings report, which flags some softness in U.S. ad spending. That seemed to trigger the recent sell-off reflected in the charts.
Gotcha. And insider selling here, too. Director Benjamin Silverman.
Yes, routine weekly sales noted in the source data. Consistent pattern there as well.
Okay, final paper money calculation. $10 into PNS, 6 months back.
All right. Entry price would have been around $25.45. So $10 buys you quite a few more shares here, about 393 shares.
And the 6-month gain was 28.06%.
Meaning the hypothetical value would be around 12,806%. That's a paper profit of 2,806%. Positive, yes, but definitely the smallest gain among the three over this specific period. Hashtag tag outro.
Okay, let's zoom out and wrap this up. We've looked at 3 key U.S. internet content and information players, all heavily involved in AI, all showing positive returns over the last 6 months.
But with very different stories, right? You have GOOGL and Meta, the trillion-dollar titans building AI moats. GOOGL's riding high on strong technicals and its financial fortress.
While Meta, despite incredible margins, is showing some short-term chart consolidation, perhaps digestion of its massive Reality Lab spending.
Exactly. And then you have PNNs, the much smaller, potentially faster-growing player.
Yeah, that's the fascinating contrast, isn't it? PNS has the highest projected growth, the highest ROE, and that incredibly low PEG ratio of 0.48.
Suggesting the market values its growth much, much cheaper than its giant peers.
But it's facing clear technical headwinds right now. The chart looks weak.
And that's the core takeaway, I think, that contrast. High growth metrics and efficiency versus current market skepticism reflected in the price action. It raises a big question for you, the listener, to ponder.
Which is?
Well, considering that huge scale difference, $3 trillion versus $22 billion, is Pinterest's amazing ROE, that 48%, a sign of just brilliant, lean operations? Or is it maybe evidence that the massive AI spending by GOOGL and Meta, which is probably hurting their current ROE a bit, is actually the cost of building a future dominance that Pinterest simply can't afford to replicate?
Is high efficiency now better than building an unassailable moat for the future? That's a great question. The cost of future dominance versus the value of current efficiency.
Exactly. It highlights the strategic dilemmas in this sector. Maybe exploring that PEG ratio concept further and why the market prices growth so differently across these names would be worthwhile.
Definitely something to think about. A really insightful deep dive today.
It was fascinating data to unpack.
Well, thank you for bringing us this detailed request. We hope this report leaves you feeling instantly well-informed.